Good morning, everybody. August 18th, 2025. I'm Herb Morgan, Senior Managing Director here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macro and economic commentary. The presentation has been prepared by me for use with you. Doesn't matter if you are a financial advisor or an individual investor, this is for you. And you're expected to make your own investment decisions. Nothing in the presentation should be treated as investment advice, tax advice, or any recommendation to buy or sell a security. Everything is informational. The views expressed are mine and mine alone. They may differ from CFIA's parent affiliates or other portfolio managers here at the firm. So what's the definition of a bull market? You get some kind of bad news and things keep going up. That's where we are. Stocks just continue to go higher. We are now firmly in double digits. There it is, double digits on the S&P, up 10.5% for the year. Mid and small cap stocks really lagging. International markets doing great as well. Bond market gave back just a tiny bit last week on some worse than expected inflation news, particularly from the producer price index. We will get into that later. But, look at that. High yield caught a bid. That's also a sign of a bull market. When the high yield bond market starts to drop and spreads start to widen, that's when you get concerned about the onset of a recession. So while there are many indicators, this one particular one is not flashing any issues at the moment. Let's move on to some of the economic data we got last week. So even though we've been talking about things might be slowing down, there's a lot of concern about the labor market. Small business optimism rose to 100.3, well above the estimate of 98.9. It was the 5-month high for that indicator, and the respondents overwhelmingly said they have increased plans for expansion. A lot of that is related to the one big, beautiful bill, but they're also waiting on the provisions of the bill to be rolled out before making final decisions, according to this survey. We move on. We then got inflation data from both CPI and PPI. CPI wasn't that bad. It rose 0.2%, right in line with estimates. The year over year is 2.7%, which is a little better than the 2.8 estimate. Core, a little worse at 0.3 and up 3.1 year over year versus an estimate of 3. Core services prices gains, core good prices gain for the second straight month. So it wasn't a horrible reading, but it certainly wasn't good. It didn't show any progress for consumers. And the next slide suggests that CPI might get worse in the month of August or September because producer prices really shot higher. Headline up 0.9 versus a 0.2 estimate. That's just horrible. Up 3.3 year over year. The estimate was 2.5, also quite horrible. Core 0.9 versus 2, same as headline, horrible. And 3.7 on year over year core. This is seen as the tariff getting priced in. So if the tariffs are getting priced in, the question is how much of that will then in subsequent months be pushed to the consumer? That's question number one. And question number two is it a one-time shot or maybe a 2 or 3 month shot and then it's over? Does it get better if tariffs are removed because of trade deals? All of this is what's giving the Fed the uncertainty that causes them to say, no, we're not ready to cut rates. We just don't know what the inflation data is going. And remember, the Fed's actions are kind of mandated by law, right? They use discretion, but they have a mandate around inflation and then a mandate on unemployment. So if employment remains good and if inflation remains high, why would they be cutting rates here? Well, the administration wants them to cut rates because they know it'll spur the real estate market, which is lagging significantly. They also know that it will lower the U.S. Treasury's cost of financing our massive amounts of debt. So they can advocate all they want, but the Fed in our country remains independent. The administration, of course, has no ability to replace the Fed chairman or any of those things. They have the ability to appoint, not the ability to unappoint or replace. Moving on, more data on prices. We had import and export prices for July. July import prices up 0.4. That's well above the estimate. Export price index up 0.1%. Nothing particularly good to see here. What does remain relatively strong, although there is debate about this now, and I'll get to that. I don't want to hide that debate. But the initial weekly claims for unemployment, 224,000, right in line with the estimate of 225. Continuing claims remain sub 2 million. This suggests that the jobs market remains quite strong. Everything's fine. Therefore, the Fed should be doing what they're doing, which is focusing on inflation. Retail sales look fine as well. The consumer seems okay, gained 0.5%, right in line with the estimate of 0.6. Backing out autos and gas still rose 0.2%, in line with the estimate there of 0.3. So everything's okay. Another bit of really good news, kind of a shock news, was New York State manufacturing. Now, you know, if you've listened to this commentary for some time, I've talked about the service sector of the economy growing and growing and doing great. Manufacturing sector, a much smaller part of our economy, has remained lackluster. One of the main initiatives of the current administration is to bring manufacturing back. They're using the sword of trade policy to make that happen, tax policy to try to make that happen. And so it's very, very early on to see whether or not they're moving the needle. But this was a massively positive print. Let me see if I can get my little cursor here. You can see right there it is, rose from 5.5 to 11.9. We haven't had a reading, well, I had one reading that high, but other than that, we haven't had a reading that high in really about 4 years. New orders rose to 15.4, shipments rose. Employment, however, fell but remained positive, and the outlook declined a little but remained positive. All in all, I would say we have the very first indicator that we might be getting ready to see some manufacturing gains in the economy, which has been, a hallmark of what the administration has wanted to do. Bring back manufacturing, grow manufacturing. This could be a one-off, but it also could be an early sign. So let's keep an eye on it. We then got industrial production and capacity utilization. This is national versus the prior slide, which was New York only. Fell 0.1%. Capacity utilization fell from 77.7 to 77.5. Well, this is not good news for overall manufacturing. It's certainly good news for inflationary pressures in the economy. Right there, you can see this is a trending lower line here. And capacity utilization is just a great indicator of the directionality of inflation. You can see back here, it was indicating inflation was going higher. If we're bringing on more capacity and therefore the total utilization drops, that's a positive sign for inflationary developments, despite a really horrific PPI number from last week. Consumers said, though we're not ready to celebrate. Consumer sentiment in August fell from 61.7 to 58.6, well below expectations. Current conditions fell, expectations fell. Sentiment mostly declined because they are worried about persistent inflation. And for the first time, they're starting to say they're more worried about employment. Remember, I said we're going to get to the employment. Even though those weekly claims and the continuing claims are pretty low, there is concern, and now you've got people making the argument that employment is actually softened, therefore the Fed is now conflicted. Which mandate takes precedent, inflation or employment? We're going to hope to learn more from Jerome Powell's upcoming speech at Jackson Hole later this week or early next week or over the weekend. Anyway, earnings. We're just about done with earnings season, so overall earnings growth about 8%. Earnings surprises by about 8%. Earnings growth I've got coming up in another slide. All across the board, it was solid. This has helped the market to be where it is, near or at these all-time highs we're seeing on a daily basis. So the question everybody wants to ask me, what's next? What's next for the markets? What matters to the markets now? I boiled it down to 5 key points. Number one, what is the direction, the path of inflation? You have seen my slides where I say the year-over-year core PCE numbers, they're going to have some high months roll off starting in September. September, October, November, and January, not December. When those months roll off, it brings the year-over-year number down. But it also matters what number replaces the month that's rolling off. That's the thing we don't know. I was feeling pretty good about it, quite frankly, until the PPI report from last week. So that's where we are. What's the path for the Federal Reserve? If the Fed acquiesces and cuts rates and says, well, we're not too worried about inflation anymore, you can see the markets take off. What's really happening with employment? What's the prospects for GDP and earnings growth? And just how darn expensive is the stock market now anyway? Let's start with inflation. So the inflation break-evens last week, you can see over here on the right there, right? They didn't go up last week, despite that bad PPI number, and that surprised me. As of this morning, 2-year break-evens at about 260. You can see the 5-year break-even, which is the orange, is at 240, and the 10-year break-even, which is the darker green, at about 240 as well. These numbers need to get down here to 2% for the Fed to be comfortable and say, hey, we can cut rates. So who knows? Nobody really knows, but that's the conflict that the Fed has right now. Personally, I think they're doing the right thing, not raising rates, because inflation is just a vicious attack on the people of our country. We move on. What's happening with employment? Well, the weekly claims for unemployment are okay. Continuing claims for unemployment are okay. But when you look at the net job gains in July, we only added 73,000 jobs. That was modest progress at best. May was revised from 144 to 19. June revised from 147 to 14. That's a subtraction of 258,000. Now the 3-month average job gain is 35,000. So if you want to make the argument for rate cuts, this is the data you point to. If you want to make the argument for rates not being cut, you point to the inflation data. And I get it. I get both sides. We do still have 4.2% unemployment, and weekly claims, as I mentioned, are incredibly low. We need to hear more. We need to see more data, and we need to hear more from the Fed, which we will, the Jackson Hole meeting. And then they've got time until it's a month away, to the September 17th meeting, where the FOMC could essentially cut rates or push out to another meeting. Now, what's happening with GDP? U.S. real GDP estimate remains very subdued for the year. Remember, we had the negative in the first quarter, but there was reasons for it because of the balance of trade. Second quarter picked up. Okay, great. But the overall estimate for the full year, if you balance those two out, is still only at 1.6% real. That would argue for rate cuts. It would also argue that inflation should be coming down on its own, and it's not. That's because of the tariff implementation. Core PCE inflation, however, remains high, 2.9%. This is the ECFC, Economic Forecast Estimate in Bloomberg. It's a consensus of economists that report in, 2.9, and then only dropping to 2.7 for 26. So for these reasons, I mean, you could sit here and argue, well, you got to cut rates because GDP rate's low, but you can't cut rates because inflation estimates are high. It's a tough situation. It does not seem to be getting any clearer or any better. Add on to all of that the valuation. This is the forward PE for the S&P 500. We're looking at about 22.3, 22.4, 22.5 right now. Not exactly cheap, not overly expensive, especially if we expect rates to come down. The market may be even telling us we actually predict rates are coming lower. So that's interesting. Economic data this week, let's move on. Housing market sentiment this morning expected to be very miserable at 34. Housing starts and building permits, 1.3 and 1.4 million respectively. Fed minutes from the FOMC meeting in July on Wednesday, I don't expect much there. Weekly claims, Philly Fed. Flash August readings for manufacturing and services. It's a familiar tune, right? Just below 50 for manufacturing and nicely above 50 for services. But remember that New York Empire State number we got? Remember that big spike? What if on Thursday morning we wake up and the national manufacturing flash PMI is above 50, suggesting a return to expansion? That could see the markets go, wow, this is great, let's rally. So the market could just about do anything this week and next. So thanks for tuning in. This is the podcast Slaying Bulls and Bears with me, Herb Morgan. We look to make the complex and complicated simple and sensible. We're available everywhere, but the best place to watch is YouTube because you get all the great charts and graphs. Thank you. I'll see you again in 1 week.